Hey, Rick McBride. I'm with McBride Mortgage today, guest posting here. And I wanted to go over the types of loans and when you would use them. Destiny's going to do her best to try and remind me of them all, because I don't have my piece of cheat sheet paper. But if I forget something, let me know. You guys can let me know as well. We got Trent.
Hello.
Here, and I just met you.
Paige.
Trent and Paige. Paige is going to be joining us hopefully. Another great teammate, and we are going crazy here. This is insane. Love it. So, a couple mortgages. First of all, first and foremost, if you're a first-time home buyer, you're most likely going to use an FHA loan. An FHA loan is government. Man, I need that chart. An FHA loan is a government loan, meaning that they guarantee it. They don't give you the money. You still go to the bank, but they guarantee it. For an FHA loan, your down payment needed is only 3.5%. So you can get into a $300,000 or a $200,000 house for around $7,500. And if Trent works it right, he can get your closing costs covered, and then that's all you will have to come up with. Okay? The second kind of loan is if you're in the military, or a veteran, or in the reserves, we have a VA loan. The VA loan is a remnant of World War II, quite frankly. Everyone came back, they didn't have any money, and they couldn't afford a home. So the VA came up with this loan. It is 0% down. 0%. So it's 100% financing. Again, you can find one of our agents. They get you closing costs covered. You literally can leave the closing table with a check because you put your $1,000 deposit down and you get it back at closing. Okay, so that's a 100% loan, a VA loan. The most common loan is the FHA. Second most common is a conventional loan. A conventional loan typically requires 20% down. However, if you have a great credit score, you can get it down to 10%, and some people can even get down to 5%. So again, that $200,000 house you buy is going to cost you $40,000 out of pocket. Conventional loans are often used when you're upsizing. So let's say you're a first-time home buyer, you bought your house for $200,000, you sell it for $300,000, you now have $100,000 to put onto your second home. You put $100,000 down, you're easily at 80% loan to value. Loan to value means the value of the property, loan divided by the value of the property, that's typically 80%. If you put 20% down, that's 80%. So your loan to value is at 80%, poof, you've upsized, your payment probably doesn't change a lot if you take all that money and put it. Really, if you take all that money and invest it, but that's a discussion for a later day. All right, but if you do that and if you transfer it, then you'll be there. All right, a third type of loan that you can use if you're an investor is called a DSCR loan. DSCR loan is much different. Whereas these guys here, so for instance, for FHA, your credit score, for FHA, your credit score needs to be 580 plus. We prefer 620, but we can do 580, but you're going to have to have some cash. For VA, there's no credit score requirement, but the lender's probably going to ask for 620. And then for conventional, you need 620, although they are approving lower than 620 these days, but it's going to cost you a ton of money. You got to have cash available if your credit score is less than 620. But a DSCR loan, all you need is a 660 credit score, and they look at the property. It's an investor loan. So, me and Paige were just discussing a minute ago investment properties. And if you buy an investment property with a DSCR loan, you got to put 20% to 25% down, but you get the loan based on how much it will rent for. So for instance, if a house will rent for $2,000, you just get a loan, and the loan amount is $2,000. And whatever that equals out to, that's how much money you get from the loan. There's no income requirements, there's none of that stuff. Okay? Your debt to income ratio on these guys is typically debt to income. So all your debt divided by all your income is typically around 50%. That's all your debt. So if that includes credit cards, car payments. So you want to figure out how much you can afford? Add up all your debt, okay? And then your income, and then the difference between those two is how much you can afford. So for instance, if you have $1,000 in debt, you make $2,000 a month, you can afford $1,000 a month payment. But don't forget, payments include 3 things: principal, interest, taxes, and insurance. There's 4 factors there. So it's not just principal and interest. You gotta pay your taxes in advance, 1/12 at a time, and your insurance 1 at a time. That said, give us a call, 386, call my mortgage number, 352-612-2680. If you want to get pre-qualified, if you want to have a discussion about what you can afford. Hey, if you're thinking about buying a house going into the new year, never been a better time to buy than right now. All the competition's gone. They're all out shopping. So you can get a great deal right now, and you can get a great rate right now, and we can have you in by Christmas if you call us today, but definitely by the new year. So give us a call, 352-612-2680. Have a great day.